So NVIDIA beats earnings expectations, and the stock drops 3%. Now, this isn't just some market quirk. It's a signal. It tells us the market has entered an entirely new phase, one I call valuation digestion. Let's break down exactly what that means for you. Let's just look at the raw numbers. On one hand, you have NVIDIA posting another incredible quarter, blowing past all the forecasts. Logically, you'd expect the stock to soar. But on the other hand, you see what really happened, a sharp reversal, with the stock closing down in a big way. So that's the million-dollar question, isn't it? Why? Why would a market that's been relentlessly rewarding AI growth suddenly turn around and punish a fantastic report from its leader? Well, the answer is that the underlying dynamics of this market have fundamentally shifted. We're going to start by digging right into this event, the NVIDIA paradox, because it's the perfect microcosm for what's happening across the entire market. It shows us everything we need to know. You see, that NVIDIA reaction wasn't some isolated incident. Nope. It was actually the result of three powerful underlying forces that have been quietly building and finally came to a head this week. Understanding these is absolutely key to figuring out what comes next. So what are these forces? First, a growing crisis of confidence in just how high AI valuations have gotten. Second, a very sudden and pretty dramatic pivot in what everyone expects the Fed to do. And third, crystal clear evidence of a split consumer, where spending is going in two completely different directions. Okay, so now let's get to the data that backs all this up. We're going to walk through the week step by step to see how these forces played out, and we'll start with the market's so-called fear gauge. Early in the week, you can see the VIX spiked from just over 22 to more than 26. Now, this wasn't just some generic nervousness. This was the market pricing in extreme uncertainty right before NVIDIA's report. The question was no longer if NVIDIA would beat expectations, but whether any result could possibly justify its massive valuation. And this feeling was perfectly captured when Ray Dalio came out and stated very plainly that the AI sector is forming a bubble. But it was his follow-up advice, but don't sell, that really nails the market's dilemma. Everyone's aware of the overvaluation, but nobody wants to get off the biggest tech theme of our lifetime. At the exact same time, we saw that bifurcated consumer in plain sight. You had Walmart, which caters to value-conscious shoppers, crushing expectations and raising its guidance. And then you had Target, which relies more on discretionary spending, lowering its forecast. This tells you so clearly that one part of the economy is holding up, while another is seriously pulling back. Now, let's switch gears to the Fed. At the start of the week, the market was only pricing in about a 29% chance of an interest rate cut in December. The general thinking was that the Fed would stay pretty cautious. And then, boom, everything changed. On Friday, Fed President Williams basically signaled a clear, dovish pivot, and the market reacted instantly. The probability of a December rate cut shot all the way up to 70%. I mean, that is a seismic shift in expectations in just a matter of days. So how do we put all these conflicting pieces together? Well, from our perspective here in Tokyo, where we often see global capital flows through a different lens, the conclusion is pretty clear. The market has moved beyond that initial euphoric phase of the AI rally. We are now in what I call the valuation digestion phase. This is a period where the market just has to pause and, well, digest the enormous gains from the past year. In this phase, excellent news isn't a catalyst for more upside anymore. It's just the bare minimum to prevent a sharp sell-off. We're already seeing smart money rotating out of these overextended names and into more defensive areas. So, here's the most important part. How does a long-term investor actually navigate this new phase? It means you have to shift from just passively riding the wave to having an active strategy. So I'm going to outline 4 clear, data-driven things you can do right now. First, you need to adopt a more defensive posture. Second, use this volatility to your advantage and accumulate core AI infrastructure assets, not the speculative stuff. Third, you've got to implement some strict rebalancing rules. And fourth, it's time to execute a deliberate sector rotation. Let's make these real with some specific rules. For that defensive posture, I mean maintaining a 10 to 20% cash buffer. This isn't about timing the market, it's about being ready for opportunities. When you're accumulating on dips, focus on the bedrock of AI, the infrastructure, not the hype. For rebalancing, here's a simple rule. If your tech exposure has grown to more than 30% of your portfolio, it's quantitatively smart to trim it back. And finally, take those profits and rotate them into sectors like healthcare and consumer staples, which offer much better relative value right now. Now, looking forward, this transition phase isn't going to be a walk in the park. There are 3 major risks on the horizon that you need to be watching very closely because they could really impact your portfolio. First, the upcoming Thanksgiving holiday in the US means lower trading liquidity, which can make any market moves much bigger. Second, that December FOMC meeting is now a massive event. The market is expecting a rate cut, and if they don't get it, expect volatility. And finally, this whole reassessment of AI earnings. It's not over. In fact, it's really just beginning.
The market is sending a very clear signal. The era of easy, straight-up gains in mega-cap tech is on pause. This next phase demands a more nuanced, data-driven approach. To navigate it with logic, not emotion, make this weekly analysis from Tokyo a core part of your investment habit.